Hi, folks. This is Sean Hyman from The Logical Investor. And if you're viewing this not on my site because somebody's sharing it or something like that, you can view this at SeanHyman.com. That's SeanHyman, SeanHyman.com. And I want to talk to you today about really being cautious about not changing a system. So once you have a system, there's something about the human nature of just something about human nature where people want to constantly tweak, change, hone, refine, and you can get yourself into trouble with what seems logical, but will really mess you up more than anything. So I want to go over some common tweakings that I've seen lately and mess ups that I've seen from current subscribers. Again, no, this is not pointing fingers at or picking on any one subscriber, but it's a learning experience for any and all subscribers and even non-subscribers that are listening to this. So one of them is sometimes when we get a portfolio of stocks, people will cherry pick stocks for various reasons. I'm gonna pick this stock because I like this sector, this is sexy and I like this and I'm interested in this and I'm into this. And I'm not gonna pick this stock because I'm not interested in that, I'm not into that. That's one way. Another way is through price per share. So for instance, we have had in a former portfolio some stocks that people bought more of, picked these stocks over others simply because they were cheap price per share. CIG was one of them. Right now it's in a dollar and something, and ELP was another one, similar industry and country and stuff like that. But again, another cheap price stock, and they bought it because, well, I can buy more shares of that. And again, I think this got a great future going for it. But how many shares you can buy of something really doesn't matter. That's just how many slices and pieces of the pie you can get. But you need to know about the strength and the quality of the overall pie. So, for instance, we've been in and out of Apple a number of times through the years. Let me switch to a longer term time frame. So, and we have done well in very large percentage moves up on several in and outs over some periods of months to years in Apple, and yet Apple was, of course, these prices today that you're seeing are on a split adjusted basis, but they were hundreds of dollars per share. But even if you took them on today's prices in 80s and 90s and 100s, 120s, etc. per share versus a stock that was $1 to $4 a share, there is a gravitational pull to something that's cheaper for price because they're like, after all, I can buy more shares of it and it can double quicker and this and that. And just because something theoretically can do something doesn't mean that it necessarily will. So in that time, CIG has, and of course we've been in and out of this profitably as well, but then there's one time where some former subscribers are still in it because it's taken more time for its turnaround, for it to have its true bottom in a wave C, first rally up, wave one, here's wave two pullback, which we are still probably towards the latter part of, and then wave three going in next to next phase of the uptrend. So, somebody, if they just bought because of their gravitational pull towards, I can buy it cheap because it's cheap per share and I can buy more shares, they allowed themselves to be swayed and they cherry picked out of the system because of something, because of price per share or how many shares they can buy rather than the quality of the company. Whereas, we had been in and out of Apple several times with large percentage gains, and yet it had been one of the higher price stocks that we had done, but this was a superior company fundamentally than the other. So I would caution you against cherry picking, which is where instead of getting a diversified portfolio of our stocks, um, and trying to have an even dispersion amongst those stocks, people will say, well, I like this stock that he's picked and I like this stock that he's picked, and I'm going to skip on these stocks and I'll pick these. I would encourage you not to cherry pick, because that does not work out more times than it does work out. So that's one thing that I would encourage you to not do. Another one is, somebody was cherry picking and didn't realize it by avoiding one stock, and I'm not going to use that example of that stock because it is currently in our portfolio, and this is a video that anybody can see, even non-subscribers. But I will use one that was in a similar circumstance, which is Microsoft. And so Microsoft had been consolidating for many years in a range. And so our stock that we're currently in had also been consolidating in a triangular range, much like Microsoft had. And so we bought it after it had been many, many years into the range, expecting the triangle to break out to the upside and produce a long, strong trend, because long, boring ranges beget long, strong trends. And so the person chose not to buy it because in their mind it was at the top of the range and it was towards a 52-week high. But again, what did they do? They inserted their own bias, they inserted their own rule, because that rule was nowhere in my system of fundamentals, fundamental strength, fundamental valuation as far as how cheap something is or how strong it is, technical analysis, and then sentiment. So they added an extra step, they added an extra rule, something that they put in extra in their head, probably subconsciously not even realizing it, and so therefore they pass on the stock. Well, the stock is already up, and there's a possibility that it could be getting ready to break out and start this next trend. And because they inserted that new rule in their head and tried to tweak the system and cherry pick, they're not in that pick that is already mildly profitable, and once it breaks out will end up being greatly profitable. But they created an extra step, an extra rule, a tweaking, a refining supposedly in their head, probably unconsciously, and it was a bias that they set up that they probably didn't even realize. And it's something that I'm wanting to bring to so you can be conscious of, is to not set up extra steps, extra refinements, extra rules, to not have biases, to have an even dispersion amongst all our picks, that provided you have the capital to do so, because that is the ideal scenario. But the person said, well, because it was towards a 52-week high, I didn't get into it. Yeah, but it was towards 52-week high that had been in a range that had been consolidating for many, many, many years. So it's not like a 52-week high like Microsoft is now, which is a mile away from its 200-week moving average and has enormous downside risk. And Microsoft is in a bubble that anytime a move starts going parabolic and gets a mile away from its 200-week moving average, specifically historically to what it's done in the past, it's in a bubble and it will pop and it will end badly. And we're already starting to see some divergence of the RSI, MACD here. And it doesn't mean that this is the top. You can't ring a bell at the top because nobody knows the top in advance. But you can know that it's high risk and to not be in it when it's high risk. So it's not like a 52-week high as in a trend that's been well extended, but it was simply at a 52-week high in a sideways range at the top part of that range that we were expecting a breakout due to how long it had been in the range, the Elliott wave counts, and more importantly, the fundamental strength of the company and the cheap PE of the company that can afford it to break out and trend for a long time before it getting expensive fundamentally. So again, it was an extra step, an extra rule that was put in there that the person, I'm sure, consciously did not think about, but yet it ended up affecting their judgment anyway. And so here's another one. I'll just go back to a general Apple example because I don't want to use our pick as the example. So somebody said, well, I've noticed that so we've got an averaging down strategy that we do in the system, in the newsletter. And what we do is as long as we know the stock is fundamentally sound, which means it's a huge market cap, it's got plenty of cash on its books, it does really well in its earnings. And of course, there are very specific metrics for that, but I'm just being general. And its debt is low and in a healthy range relative to its market cap and size. Then we know that the company is fundamentally sound and worthy of investment, as long as it also is fundamentally cheap. And so how do we know that? We know that by the price to earning ratio is one of the biggies. So you can always know when a stock is at a value. You can never know when a stock is at a bottom. So how do you get closer to a bottom, being that you can't know it? The way that you get closer to a bottom without knowing where the bottom will end up being in the future is you employ an averaging down strategy. And so if you want to know more about that or any of these facets of my system, in the Ask Sean section of SeanHyman.com, I've literally got articles and videos on this stuff, how to know when to buy and when to average down on your investments. I've got one that talks about the fundamentals that we use that give us confidence. That's the fundamental piece of the strategy. Technical indicators explained, which are the technical analysis part of the equation that I use. How to tell the stages of a trend and the sentiment that is with each stage of the market. That goes over Elliott waves. So that's in the video where I talk about one of my most valuable tools in analyzing trends. So all this stuff is in there in the one tab, which is the Ask Sean tab on SeanHyman.com. So I would encourage you to check that out. But they were saying, I noticed that when you start investing, that the price of the stock ends up going down from where you invest before it goes up. And so the person was trying to tweak the strategy into basically saying start investing later than when we would normally pull the trigger on it. And they even went so far as to call it a value trap, which is silly, because a value trap is something that appears cheap but is really cheap for good reason, because it's fundamental crap. So we don't buy fundamental crap, and we do buy stuff when it is cheap PE-wise. But just because something is a value does not mean that it can't get to be a greater value before it is actually turns around. Just like a stock like Apple right now is way overvalued on a fundamental and especially a technical basis, but yet it can go from being overvalued to even a greater point of overvaluation before heading back down. So both bottoms and tops are irrational periods in time. So there's no logical reason why Apple should be this high, and it poses enormous risk. And you can see anytime the price gets very far away from its 200-week moving average, historically, it comes back to that. And of course, this time around, I believe it's going to come back to that and then some, because it hasn't had a real bona fide downtrend, which is a three-wave massive downtrend in Elliott wave terms, in quite some time. So I think it is going to be a very large downtrend, which will far surpass the 200-week simple moving average this time around. But nonetheless, it's an irrational move towards the end of a five waves up move, just like the ABC downtrend. When those happen, a stock will go lower than it should ideally go, because emotions are involved on both ends. The emotion of greed is involved on this end, where they're pushing it up to oblivion and thinking that it can never turn lower. And they also have the fear of missing out, because every day they feel like it's going to go up, and they don't want to sell out, because they feel like just if they sell out, it's going to keep going up on them. So greed takes hold of them, so they won't sell out at a point of overvaluation. In fact, they even keep buying more. And the same thing happens in a downtrend. Is a stock will go from 89 to 50, and it really shouldn't have gotten pummeled that hard, but it's an irrational move and takes something to very cheap PEs fundamentally, and it just takes it to a level that it really shouldn't go to, but it goes to those levels because of the emotion of fear, because the news media coverage will be, oh, Apple's never coming back. It's a has-been company. It's not the same without Steve Jobs. It's past its time. It's over the hill, blah, blah, blah. And that's what happens near bottoms. And then the next rally comes up. And then as this is starting to happen again, and it goes from 126 to 80s, the same story unfolds in it with a little bit different slant to it, but the same type of negativity, fear, and sentiment in the market. And so, it shouldn't go as low as it does, but it does go very low because of those reasons. So just like something gets more overvalued than it should, even though once it enters the state of overvaluation, it'll usually get even more so before it comes back. The same thing happens when something shoots from to the downside. It typically goes to a value, to an even greater form of value before heading higher. So the person's rational thought is, why not let it go even further to a further point of value before ever getting into that? But the point is that you have to start investing when something is of value, because sometimes it doesn't get to be a greater point of value, and it just heads up from there, and it takes off, and the train leaves the station without you. So one of those prime examples was Foot Locker. We got into Foot Locker when Foot Locker was a fundamental value, and the stock just shot up. And the person who was waiting on the deeper value to come, they're going to be waiting for a long time because it never came, and the train left the station without them. And so with them trying to add an extra rule and do further tweaking, they would end up missing the boat on the entire investment to begin with. But we also know that more commonly, a stock will get to be an even deeper value. So how do you balance that with the ones that become a value but don't become a deeper value and just take off, with the ones that become a value and become a deeper value and go down lower before hitting higher? Well, that's why we enter when the stock is a value, not knowing whether it's at its deepest value or not, because nobody can know that. I mean, if you're human, unless you're God, you don't know that. And so you put in your first third of your investment money when it is at a fundamental value, and that takes care of not being on the train when it leaves the station. And then, as if it were to go down to a deeper value, for instance, if this were gotten into, let's just say at 40, and it became a deeper value, and so you're in at basically 40, and then it goes to deeper value and it goes to 27, let's just say, and you're able to put in another round of investment, and then let's just say it goes down to another area of value in the 14, 15 area. So you've got your first round of investment when it's a fundamental value, then it gets to be an even deeper value, and you put in your second third of investment, and then it goes to a crazy deep value, and you put in your third round of investment. And even if it goes down further, you are much better off than if you just stuck with putting everything in the first round of investment, because your average break-even price ends up being somewhere here in the middle, and percentage-wise, you've lowered that break-even price a lot, and then when the price bounces back, you get back profitable quicker than if you'd gone all in with the one round of investment, and so forth. So it is the balance of making sure you're in the investment so that the train doesn't leave the station and you see it at a value, yet you don't capture it at a value, and it runs off and leaves you. That's why you get a foot in the water while it is at a value, because you never know if it'll go to a deeper value or not. But yet there are many times where the price will go to a deeper value because stocks fall further than they fundamentally should, because there's human emotion involved with human investors and traders. For instance, on Foot Locker, fundamentally, this should have never been as high as almost 76. Just in a few years' time, it went from 7 to 14 area all the way up to 70s, and that was it had gone too far too fast and it overshot to the upside. And then, a year or so later, all of a sudden they here's how fickle investors are. Not only is it not worth 76 almost, but a little over or right at a year later, they decide that it's valued at only 27. Well, this is greed here, them pushing it up too far, much further than it should have ever gone. And then this is fear here, pushing it down further than it ever fundamentally should have gone as well. And the truth is usually somewhere in the middle, not on the extreme greed side at the top of wave 5 in the uptrend, and not at the extremity of wave C, ABC, in the downtrend, at the bottom of the downtrend. So you never know how low that'll go. Now you say, well, what if you do your averaging strategy and you don't get able to get all your position? Let's say you get this one in and this one in, but you're not able to get this one in. Great, then you've got cash that you've got left over that you can use for another pick of another stock in your portfolio that you've got that it's gotten beaten down and undervalued. You can average down for it, or you can use it to keep cash set aside for a general market correction to take advantage of some dips along the way of a current holding or a future holding that we have. So there's never a problem. Once you are a seasoned investor, you will realize there's never a problem with having too much cash, because with more cash you can seize any and all opportunities that are coming along the way. The problem is being cash poor and not having any cash, because then if something pulls back significantly percentage-wise, you can't average down. If you see a stock that's a value, you can't take advantage of it, and then it just runs away from you, and it's an unseized opportunity. So cash is valuable because cash is able to seize unusual temporary anomalies that won't be there forever to get unusual sized returns that are market beating returns over time. That's the value of having that cash, not the value that having 1% interest or 0.5% interest or whatever that it's going to earn you in your money market account while it sits there in your brokerage account. That's not the value of it. The value is being able to seize and take advantage of the opportunity. So we've got a three-pronged averaging down strategy where we'll put in 1/3 when the recommendation is given, a second third if it drops big enough percentage-wise, which will usually be at least 10% or more drop. More is better, but we also judge that by percentage drop and also near previous major support levels. And we do the same thing for the third round, to where what the strategy is, we're trying to get our average break-even price closer to whatever the bottom would be. So let me give an example using the same chart. Here's how most investors will invest. The stock goes from 75 to 65, and so they say, well, it's already dropped $10 a share, and I missed out on these other dips that it had, so I'm going to go ahead and buy in. So they buy all in at $65 a share. So 100% of the money they had to commit to that stock, they buy it in there. And then it goes down significantly on them. Had they had an averaging down strategy, well, for starters, if they were using fundamentals like we do, they would have known that the fundamental valuation was way too high and they would never started investing here. But let's just say they did. Let's just use an averaging technique, irrespective of fundamental valuation. Let's say they had bought their first third here, and then another third here, which would have been near the range at the end of a previous dip, and then another third here, which was at another area of what would have been support and resistance area right in here, carried into the future. So their average break-even price with a third would be right in here, would be their average break-even. And so when this turns around, when it gets to 59, they're already up from their average break-even price of 48 to 59, and this is with them not considering fundamentals and getting a sucky start because it's starting too high, not even starting at a place of value. They're already up on the stock from 48 to 59 when it gets here, Whereas the person who went all in when it went from 75, 76 down to 65, and they're thinking they're getting a bargain there, they're all in here at 65, and even when it still has this big rebound from 27 to 59, they're still not even back to break even, much less at a profit. But the person who got in at call it 48. So let's take a look at that. So 59 minus 48, got your 11 divided by 48. So you would have, excuse me, so in the one instance, you would have a 22.9% return, so almost a 23% return, and in the other, you're still at a loss. So big difference, and that's why averaging down is part of the very crucial piece of the secret sauce of our investing strategy, and you don't want to cherry pick and decide, well, I know he gave the buy recommendation, but I'm not going to buy now. I'm going to wait and buy later, because the stocks that take off the quickest are sometimes some of the ones that have some of the greatest percentage gains, and you will totally miss those quicker gains and greater gains because you're trying to cherry pick the entry. So again, it's a fallacy. In a novice investor's head, all of these things make sense. It makes sense for them to cherry pick, and they shouldn't. It makes sense for them to pick cheap price stocks because they can get a bunch of shares of it, but it doesn't end up working out really in their favor. It makes sense for them to decide, well, I'm gonna pass on this stock because it happens to be at a 52-week high, not taking into account that it's been in a long triangle pattern for many years. And it makes sense for them to say, well, it's been my observation that when he gives the buy recommendation that it usually goes down some more before getting in. So sit on your hands even longer from when he gives the buy recommendation to start getting in. But by doing so, you miss out on some of these trains that totally leave the station without you. So again, there's a lot of reasons why I have the strategy like I do. Again, I've been watching markets for over 25 years. So that's as long as probably a lot of you did your profession and whatever you did. So imagine how seasoned you got at whatever it is that you do: plumber, electrician, teacher, IT person, whatever it is that you did as your career for 25, 26, 27 years. Imagine how seasoned, how much of an edge and how good you got at that over time because of those observations. And imagine the edge that you would have over somebody who's been doing that 6 months to 5 years. Imagine that edge. Well, that's the edge and the experience and the season that I have over many of my subscribers, because they will fit probably somewhere in that having never invested to invested 5 years or under window. And many times if they've invested longer than that, they've invested unsuccessfully. And so that's why they're with me now. So there is a method to the madness, and I would encourage you to always follow the system to the T, and to never be conscious of your thinking, because I'm telling you, over time, it is human and natural to think, well, I'll add this, well, I'll subtract this, well, I know Sean normally says this, but I'll do this. There's just something in our thinking as humans that wants to do that, and it's almost always an error. So and what you're going to find over time is, if you see subscribers that are with me long enough, you're going to find subscribers that do phenomenally well, and unfortunately you're going to find subscribers that don't do as well, and yet they're still paying the same fee, and they're still listening to the same weekly videos, and they're still seeing the same monthly newsletters, and they're still seeing the same buy recommendations and sell recommendations and all at the very same time, but they're getting two different results. And the difference is the one that's having the great success is listening and following instructions to a T. And the other camp, they're like, well, I think I'll do this. I think I'll add this. I think I'll subtract this. I know Sean said this. I think I'll do this, but I think I'll do this. And I promise you, it's not to get you to follow me for ego's sake. I'm too old for that. I even know going in that some people listen to me better than others. So I have a soundness about that. I know that everybody that subscribes won't listen, won't follow. I wish they would, but I've been doing this too long to where I've come to grips with that. So it's not an ego thing. It's not a, do what I say, listen to what I say thing. It's trying to teach you a concept that will help you and just get it regimented in your mind that, fundamentals matter the most, and to pick the stocks that have the best fundamentals, not the lowest stock price or the something that you get the most, the biggest per share. To not cherry pick and to not try to tweak the averaging down strategy. So if you can get some of these, and there's probably others that are out there that are other ways that people can tweak the strategy, but these are just some of the common ones that have come up over the last couple of weeks in our discussions on the site that I really believe that will help you to not re-engineer the system in your head and get a less favorable result, but to be conscious of your thinking and to follow the system exactly so that you get a very favorable long-term outcome. Okay, thanks so much for watching, and God bless. Bye.